I want to thank everybody for attending. I'm Jeff Rubinger. I'm an international tax partner with the law firm of Bilson Sundberg in Miami. I'm joined by my colleague Jennifer Weinsack, whose focus is on international trust and estate planning. And we're fortunate to be joined by Camila Cortez from Dentons, Cardenas in Bogota. The topic today is the Colombian tax reform and how it affects U.S. tax planning with Colombia. So we're going to go over some inbound and outbound structures, both on the corporate side and the private wealth side. And this is meant to be pretty informal, even though we're taping it. So feel free to stop us anytime and ask questions, either during or after the presentation, and we'll try to answer them the best we can. So, Camila, we'll start with you.
Okay, thank you, Jeff. Good morning, everybody. I received the invitation from Jeff to talk about the new tax bill that was recently enacted in Colombia, which is a quite comprehensive tax bill that deals with a lot of issues. It is a new law that has more than 380 articles, which you have to review the interaction among them and the interaction among the current tax code, which is a very difficult task. Today we're only going to focus on what we deem are the most relevant issues that could affect the inbound and outbound structures regarding to U.S. taxpayers or Colombian taxpayers making investment abroad, even though there are like some general rules that are applicable to the whole wide scenario of Colombian taxpayer. So there you have the agenda of the different issues that we're going to discuss. Just to let you know a little bit about the background of this bill, the first issue is that there is a recognized tax deficit in Colombia, and the major point and the one that gave more discussions was the increase of the VAT tariff from 16 to 19%. That was like all the discussions that took place, and that has some important consequences regarding to the text that was finally approved, because the first project that was presented by the government suffered a lot of changes at the end. The story is that once the government got the approval of the increase in the VAT tariff, then it quite didn't make much efforts to preserve the original project that was much more consistent, much more organized, and then it left it to Congress to make all the discussions. So a lot of the inconsistencies and loopholes that are in the articles can be attributed to the form in which the approval took place. That's something important to consider. The other issue is that, or the other motivation for this tax bill is that government was conscious that we had a very high corporate income tax rate compared to the other players in the region that can attract foreign investment. So we were talking that, for example, in this year, if no change were made, 42% net corporate income tax rate would be applicable, and that was one of the considerations to issue this law. Also, we're in the process of changing from Colombian GAAP into IFRS. All those changes have been approved, and there are quite many rules in this new law trying to adapt the new changes for accounting purposes, maintaining the principle that now for tax purposes IFRS will be the driver, but with a lot of exceptions which will in practice lead taxpayers to have to set up accounting records in order to duly comply with their tax obligations. And the other important set of rules was regarding the following of the OECD guidelines, all the BEPS actions, and you can see lots of them reflected in the law. There are lots of sections following the OECD guidelines, since Colombia is trying to become an OECD member. So I think that those are like the four major background issues that must be considered when analyzing the tax bill.
Okay, we have some common U.S.-Colombia tax planning structures. We have them laid out here. We're going to refer back to them as we talk about the topic, so I'm going to skip over these slides for now, but we will come back to them.
Yeah, as I told you before, being aware that we had a very high tax rate, one of the issues here was to reduce the corporate income tax rate, but giving all the budget and planning, you can see there the evolution of how that has been evolved since 2012 until now, and the idea is that following in 2019 we will have a 33% corporate rate. For this year we will have a 34% corporate rate with a 6% surtax. And in the next year, the idea is to have a 33% rate with the 4% surtax. In both years, the surtax will be applicable for the companies or the companies that have profits exceeding around $250,000 per year. So it's a rather low threshold, but the idea is to unify and have a 33% flat rate in starting in 2019. There also was a major regulation regarding free trade zones, which in general they were subject to a preferred 15% income tax rate, which was increased to 20%. There were some differences regarding the free trade zones that were incorporated after 2012, which had different rates, but now they are all unified at the 20% rate.
Okay, obviously with such high corporate tax rates, if you have in an outbound structure, if you have U.S. individuals investing in Colombia, it's going to be much more tax efficient, as it probably was before, to simply check the box on a Colombian operating company and claim the foreign tax credit, assuming you're not a Colombian SA. So what I'm referring to is if you're investing in Colombia and you have a Colombian operating company, normally those after-tax profits, when you pay a dividend, the U.S. shareholders cannot claim a foreign tax credit for any corporate-level taxes incurred. If you have a C corporation on top, so a taxable U.S. entity, you can claim an indirect foreign tax credit. But again, if you're individuals investing in Colombia with such high corporate tax rates, it's going to definitely make more sense to check the box on your Colombian operating company and claim a foreign tax credit. And clearly, if you leave your entity as a corporation for U.S. tax purposes in Colombia, either because you have an SA or some other reason, you're never going to be subject to the U.S. CFC rules under the high tax exception because of having a tax rate greater than 31.5%. But just one point to note, the high tax exception, which exempts U.S. taxpayers from Subpart F under the CFC rules, doesn't apply to so-called 956 inclusions. So if a CFC in Colombia makes investments in U.S. property, even though the corporate tax rate is so high in Colombia, you can still potentially have a deemed inclusion for U.S. tax purposes.
Yeah, following also regarding the corporate tax rate, there was we have in Colombia this minimum alternate tax or presumptive income, which states that you must determine your taxable income between the higher of the regular or ordinary base of all your regular income and costs and expenses, or you must compare that to the liquid net worth of the 31st of December of the previous year. So now in this case, we have that minimum alternate tax that was 3% of your net worth of the previous year was now increased to 3.5%, And I understand that here in the U.S. have been some issues regarding the application of the CFC rules if you determine your tax on a regular basis or under the minimum alternate or presumptive income. I don't know, Jeff, what have you seen in that case?
Jennifer?
Yeah.
We'll talk about that after.
Okay. The other interesting issue there is that the wealth tax that started around 2011 and which has evolved until this year was also eliminated. But however, the ongoing obligations regarding companies where 2017 is the last year to pay and apply for the wealth tax, they still have to pay it, and for persons it will be applicable until 2018. But it is clear under the law that apparently the wealth tax has been eliminated. An interesting comment to make there is that this wealth tax that was introduced in 2014 as a wealth tax, which was a continuation of another one that was incorporated in 2011, but under the different name. The Constitutional Court declared that it was exactly the same tax, so the people that had stability agreements under the previous wealth tax would not have to apply this new one. In order to calculate or to determine the net tax rate applicable to companies in Colombia, we must also consider that a new dividend tax has been established. Since until 1986 we had this dividend tax, and since 1986 until now there were no dividend taxes, provided that the profits generating the dividends being distributed to the shareholders had been taxed at the corporate level. So this is a new situation, and the idea is that there are like three different set of rules on how to apply this dividend tax. When dividends are distributed between Colombian companies, the tax will not be triggered. The tax will only be triggered upon distribution of the same to the person's shareholders or to the foreign shareholders. There is no particular reason no particular reason why a difference was made between the rate that will be paid by the foreign shareholders or the Colombian shareholders. And I understand that there has already been a suit before the Constitutional Court on claims of discrimination, considering that the rate for foreign shareholders is 5%, while the rate for Colombian shareholders is typically 10%. So that's something that we will have to wait. What's the outcome of that particular claim?
The withholding tax?
Yes, it will be withheld at the moment the company pays the profit. It is also applicable to the distribution of profits of branches or permanent establishments.
Camilo, does it also apply to if the shareholder is a trust? And how do you look to who is in fact shareholder when you have a trust sitting above a Colombian company? Are you looking to the trustee, the settlor, the beneficiaries?
I mean, the trust is the registered shareholder, so it will be considered a foreign shareholder, and the 5% rate will be applied.
So one of the things we talked about yesterday, what kind of is interesting to me, is you could set up a non-Colombian trust with a non-Colombian trustee, have all Colombian beneficiaries essentially, and take advantage of the 5% lower rate?
In principle, yes, but then we'll have to look on how the CFC rules would apply or not to that particular trust. It's also important to mention that Now that we have the dividend tax, now the treaties that Colombia has executed with other countries now are relevant, since many of them have preferred rates or even zero tax regarding the dividends distributed to the companies or shareholders located in that jurisdiction. So that's the case of Switzerland, Chile, and Spain. And in the case of the other treaties with other countries, they will be relevant with respect to the profits that have not been taxed at the company level, which in principle would be subject to the 34% rate, but under those treaties, those dividends will have some sort of benefit. So in the particular case of dividends where treaties were not relevant, now they are important to do the tax planning and how to make the inbound investment to Colombia.
And Camilo, is there some sort of grandfather rule for if a corporation has earnings and profits in the company that hasn't been taxed or distributed out yet? Will this new tax apply to those profits?
Yes, there is a special provision stating that the tax will only be triggered for profits generated starting in 2017. All the retained earnings prior to December 31st, 2016 will not be subject to the dividend tax.
Okay. So even though it's just a 5% tax, it doesn't seem that high. When you're considering Colombia already has a 40% corporate tax rate, which is higher than the U.S. tax rate. Any tax is higher than the U.S. tax rate. You're just losing those taxes. You can't claim a foreign tax credit. So using the treaties that Camilo mentioned, such as Spain and Switzerland, to eliminate that withholding tax becomes more important. From a U.S. perspective, again, if you have individuals investing in Colombia and you're trying to get qualified dividends, I think a Spanish ETVE or a Swiss holding company would make more sense over Chile, especially since the U.S.-Chile treaty is not yet in effect. Also, Spain and Switzerland both exempt dividends from most operating companies under the participation exemption regime. I guess the question I have is, do the Colombia, most U.S. income tax treaties have limitations of benefits articles. Does Colombia have anything relevant that if you just interpose a Swiss holding company on top of Colombia to get the exemption from withholding?
Yeah, you have to look at in the particular treaty and how the treaty shopping rules are applied. For example, in the last treaty that Colombia subscribed with France, they have the new, I think it's Action 11, BEPS Action 11, where they try to impose like more substance and to avoid the treaty shopping. But I would say that, for example, under the EDBE regime, those companies typically have enough substance that only having the EDBE making the investment would be enough.
Okay, thanks.
There were also significant changes in the withholding rates applicable to payments abroad. There was setting up a general 15% withholding rate, which it is like the general withholding that is applicable. In principle, in this case, also now the treaties become relevant again, because before technical services, technical assistance, they were subject to this 10% withholding, which is the same rate applicable in most of the treaties. And now that 10% rate, if the payment is made to a non-treaty jurisdiction, will be subject to this 15% withholding. So again, the treaties become relevant in order to have some preferred rate. You can see there are some examples of the different types of nature of payments. For example, in interest, it will be increased from the 14 to 15% withholding. Also, in that particular case, you must look into treaties whereby, for example, in the case of Switzerland and Spain, interest payments are subject to zero withholding if they are made to financial institutions. So that's something that you have must be considered. The only case in which I believe the rate was reduced was in the payment of royalties, which previously they were subject to the 33% payment. So in those cases where people try to set up a payment of royalties through treaty jurisdictions, now it's not that much more expensive to have it on a non-treaty jurisdiction. There was also this new rate applicable to capital gains of 10%, with raising the situation that that 10% is applicable to the gross payment made to the foreign seller. And since the capital gains rate is 10% of the profit, it will typically trigger the obligation to, or it will typically trigger a refund and have to put the foreign shareholder or taxpayer in the situation to get the refund of the excess of the withholding made by the Colombian withholding agent versus the final tax due. So that's something that must be considered.
Is it, with Spain, for example, that withholding rate on the capital gains, is it reduced any further, and is there limits on participation?
In the case of Spain, there is this exemption if the seller has more than 20 or 25% of participation in the company, and the company's net worth does not have more than 50% represented in movable property, then the sale of shares will be exempt, and the 10% withholding is not applicable. So, and that's the case of Spain, Canada, Switzerland. Most of the treaties we have that exemption for capital gains, and in both cases no withholding and no tax will be due, notwithstanding the obligation to file an income tax return in order to go to the central bank and have that cancellation of the foreign investment. Also, if you can go back, there's also another issue regarding the overhead expenses. What happens with the overhead expenses paid to the parent company is that if those expenses or the revenues derived from the rendering of those type of services, which in principle do not generate Colombian source income if they are not technical services and rendered outside Colombia. Previously, they did not have any withholding. Now, regardless of the place they are rendered, they will be subject to the 15% withholding, even though they are not technical services or technical assistance. So that's something new. What happened in the past was that in the cases of those services which were not subject to withholding in Colombia, they were subject to a restriction of that more than 15% of the taxable income. You could not include all those type of payments abroad that were not subject to withholdings, which is specifically the case of this type of overhead payments. Again, you can see there like the rates and what happens in the payments with treaties, and also what will happen to payments in favor of companies located in tax havens or whose term has now been replaced for non-cooperative jurisdictions. In the case of withholdings, and Jeff will follow on that, there was also a change regarding the payment of commissions abroad regarding the purchase and sale of goods. What happened before this law, those type of commissions were expressly stated that those commissions, which typically again do not trigger Colombian source income, since they are commissions generated abroad, they were not subject to withholdings, and provided they were within the range of 5 or 10%, depending on the nature of the goods, those payments not subject to withholdings were not subject to any limitation regarding its deductibility. That particular provision was repealed, and nowadays the payment of those commissions even though they will continue not to trigger a Colombian source income and will not be deductible now and will not be subject to the withholdings, they are subject to the restriction of the 15% of the taxable income.
Okay. I guess one question I had, again, you mentioned now there's a 34% withholding going down to 33% when the payments are made to a non-cooperative jurisdiction. Previously, Colombia used a list of tax havens.
That's right.
And excluded from that list were places like Barbados, the UAE, Monaco, and other places. Do you think the definition of non-cooperative jurisdiction will be expanded from just the tax havens, or will they add on to that? Or
what happens is that in the law they have now the criteria to determine whether or not it's a non-cooperative jurisdiction. They say that they say that the term tax haven will be replaced by non-cooperative jurisdiction. So the current list, I understand, or I think it will continue to be applied. They also have the obligation to update the list, as expressly stated there, and they determine the criteria on how to determine whether or not a jurisdiction is non-cooperative, and they set up like 5 or 6 different situations whether to determine or not if it's cooperative or not. The first is that the lower tax rate compared to Colombia. To the Colombian rate on a similar transaction. That's what it explicitly states. Second, it talks about exchange of information. Third, it talks about transparency, and fourth, it talks about if there's a lack of substance in that particular jurisdiction, if there's no requirements to have a substance in order to apply that regime. So based on those criteria, the government will update the list of those jurisdictions.
Okay, thank you. I'm just going to go back to one of the structures that we have here. This is one of the structures that I worked on previously, and I just want to talk about how this worked under the previous rules and how it will work now. This was a Colombian operating company that was growing flowers in Colombia and exporting them outside of Colombia. And this was a type of structure. We didn't want to check the box. We wanted to get the funnel of the profits and then repatriate the after-tax profits as qualified dividends to the U.S. Shareholders, which were individuals. So what we did, we used those rules you mentioned where commissions used to sell or export flowers outside of Colombia, as well as loans or financing to export flowers, were both exempt from withholding tax in Colombia and not subject to any limitations on the amount of deductions. And what we did is we filed check-the-box elections, or we made both the Colombian operating company here, and in that case Panama, which was excluded from the tax haven list. We basically stripped the income out of Colombia into a territorial tax system like Panama, and we got the full, and then eventually the profits came back to the U.S. at a 15 or 20% rate. Now, under the new changes, you're saying that the commissions will be subject to withholding, but still not subject to a deduction limitation. Is that correct?
No, they will not be subject to withholdings because it's not a Colombian source income typically, but they will be subject to the limitation.
Okay. So
and in the case of the interest, those interests to finance or pre-finance export activities, those interests do not trigger Colombian source income. So in that particular case, no withholding will be applied, and the provision that states the restriction on the deductibility of those payments also expressly includes that those payments will not be subject to the limitation.
Okay, and finally, this is not in the structure. If you're also trying to license IP from a particular jurisdiction, let's choose Switzerland to Colombia. Now, again, under the treaty, there's a 10% withholding.
That's right, yes. And since it will be subject to the withholding, then the limitation does not apply.
Okay, thanks.
Other important changes to mention under the bill, one is that now the goodwill can be part of your cost, but it is not amortizable or deductible for income tax purposes. There's also a grandfather clause for the application of the amortization of that goodwill. So goodwill acquired prior to 2017 can still be amortized, but not anymore. We also had an unlimited carry forward of losses. Now it has been reduced to a 12-year period. And another significant change is regarding the statute of limitations, whereby the general rule was that it was of 2 years. Now it has been extended to 3 years, and there are some exceptions that have a higher expiration of that statute of limitations, which applies to the returns where losses are generated, where losses are compensated. And there's also another exception to the general term, and it is in the case of the companies that have to file the transfer pricing return. In those cases, they also go to the higher statute of limitation of 6 years.
Camilo, just a practical question. How are the Colombian tax revenue authorities situated right now? I mean, are they in a position to handle all these changes? Are they going to have to hire more people? What's the general consensus down there right now?
Yeah, I think that currently it's difficult for them to control and to follow on all these changes. But there is expressly also another chapter in the law on how the tax authorities in the tax administration must modernize and have the capability to follow with all these changes. Currently, what happens down there is that there is a set of taxpayers, so-called major taxpayers, which each year the government by resolution says which are the major taxpayers, and those are the ones that are subject to the major investigations and audits. Even though you can find some surprises of the capabilities of the officers making the audits. I, for example, had a couple of weeks ago a visit from a tax official to a branch of an oil company that we're the legal representatives, and we have all the books on there. And they were going to audit all the VAT issue of that company. And when the officer comes and she asks about the nature of the company, we said that this is a company that has an E&P contract with the National Hydrocarbon Authority. And she did not know what the National Hydrocarbon Authority was. So you can imagine how the outcome of the visit came. We also have changes in transfer pricing, also following BEP actions, also determining the country-by-country reporting master file, following the same principles of the OECD guidelines. Also the application that the preferred method will be the COP method for the application of transfer pricing rules, and also the fact that, as I told before, that the statute of limitations for taxpayers that are obliged to file transfer pricing returns is extended to 6 years, so that authorities have more time to visit and audit those type of taxpayers.
Before Camilo gets into the tax amnesty for Colombia, I think just a general comment, and most of the people I think in the room understand this, but just in case, I think we're seeing a lot of movement in tax amnesty world across the world, in particular in Latin America. Peru has opened up another tax amnesty. Mexico's doing some changes. This is probably going to be a situation for at least the next couple of years. We're going to see more and more tax amnesty work, and it's important that when we're working with our clients, we're asking if they have declared assets or income in their home country, and if they haven't, we need to be conscientious that these other countries have these tax amnesties, and we should probably be directing our clients to go into these. So, with that said, Camilo.
Yeah, the tax amnesty is not new, but I think it was worth mentioning for this presentation. This tax amnesty comes from the tax bill of 2014, but it's still in 2017 we have like the last chance to include the assets that have not been reported in Colombia, paying this 13% penalty. From a practical perspective, this amnesty will be reflected in the net worth return, in the wealth tax return that is supposed to be filed around May of this year. You will pay the tax or this penalty in two installments, along with the other part of the wealth tax. It is important to know that if you have assets abroad that have not been reported, it is not necessary to repatriate those funds. They can still be maintained abroad, and that fills in with a new return that was established as of 2015 in Colombia, where along with your income tax return, you're obliged to include or report the assets that are owned abroad. And depending on the value of that particular asset, you will give the more detailed or specific information regarding of that asset, regardless or not if it was subject to the amnesty. That's like a general provision, but it's important that once you include assets that are reported abroad in your wealth tax return, where there is no detail about the same, you are also in the obligation to include in that special return for assets owned abroad. There has been a lot of discussion and planning around how to report the shares in companies owned abroad. If those shares are reported under face value, or they are reported on the intrinsic or underlying value of the assets of that particular company. So you have like to look on a case-by-case basis how the net worth of that particular company was created or was generated, because in certain cases it is possible that the income or the growth of the net worth of that particular company was generated outside Colombia through a non-Colombian source income, and based on the other net worth rules, it is possible to include as cost basis the nominal value of the shares of that particular company. So you have to look in each particular case if that's applicable or not. If the company generated directly its profits and growth its net worth, or if that growth was by contributions or loans or anything of that nature made by the Colombian shareholder. So there are some opportunities there.
And just so we go across the board, what about trusts? How are they being viewed in this program? There's only one provision talking about trusts, and it talks about if you want to include trusts in the amnesty program, they will say that those trusts will be treated in the same way as a local fiduciary agreement. So, which is weird, because it's a completely different figure, but they try to that's what they expressly state, that if you want to report or include rights in a trust, they will give the same treatment as a local fiduciary agreement. That prior to the new rules, they stated that in order to report the net worth value of your rights in a local fiduciary agreement, the fiduciary company certifies the value, the net worth value of that particular fiduciary agreement, and they try to replicate that in the trust.
and the certifications that are given by the fiduciary companies in Colombia are based on the commercial value of the underlying assets under the fiduciary agreement.
And just last question, do you think that the Colombian amnesty will continue beyond this year, or do you think this is the last?
I think this is the last call.
This is the last call.
With that fiduciary agreement, the one who would pay the repatriation tax, would it always be the settlor, or is there certain agreements where it would be the beneficiaries?
The principle is that that is reported by the one that has the economic exploitation of the assets under the agreement. So it might be the beneficiaries, it might be the settler. You have to go to the general net worth rules to determine who is technically obligated to report that net worth. So in some cases it can be the beneficiaries, in other cases it can be the settler. Okay, now we have a more, they expanded the criminal actions regarding tax situations. Before this law, we only had some criminal actions regarding people that collected VAT and did not pass it on to the government, or people that made withholdings and did not pay it to the government. Now they included a new criminal situation, which is the omission of assets, or to omit assets or include in existing liabilities. They put a threshold of around $1.5 million, and the condition in order to start a criminal action is that this omission of assets or inclusion of inexistent liabilities affect your income tax due. It does not say, for example, if you do not report assets which were not included in your wealth tax or in the amnesty program, that will not give rise to the criminal action. It is strange that the same day the bill was issued, the general attorney or the general prosecutor sent a letter to the Minister of Finance saying that in his view the form in which this particular provision was worded made it almost impossible for them to start any cases. So that's something that we'll see how it moves on. The argument or the reasons gave by the general prosecutor was that only if that affects your income tax, he can start the investigation. But in that letter he stated that if you do not include assets, your income tax will not be affected, which is not totally true, because if you have a minimum or the presumptive income or the alternate tax, if you do not include all of your assets, your income tax can be affected in many cases. And there is also this other provision that states that if you have not included assets and the authority finds about those assets, they will deem that the value of those assets it's a taxable income. So at the end of the day, I think that technically, in the cases that you do not include assets, you will always be in the situation affecting your income tax.
I think this is what everybody's been waiting for. The CFC rules.
Okay, yes, as you can see there, we have the new CFC rules, and it is applicable to foreign entities directly or indirectly controlled by individuals subject to income tax in Colombia, which directly or indirectly control the foreign entities and which have a holding participation equal or higher than 10%. So now the question and the issue to determine there is how to determine if there is control or not, and they make a reference to the transfer pricing provisions that determine when there is a case of control. So in the particular case of trust structures, when you go over the different situations contained in transfer pricing regulations, which are made for a different purpose, it's very difficult to determine if where or who is the controlling party. So I don't know exactly what will happen in those cases, and I think there's going to be a lot of discussion on where there is control, or even also in the case of the 10% participation, because in certain cases, for example, in a discretionary trust, how do you determine if you have a 10% participation or not? So I think that this will be subject to many discussions. And also, I think that there were some of these situations where there is incompatibility of these rules with other rules. For example, in the case, if you go to the conclusion that in a trust, for example, CFC rules will apply, I don't know how that matches in with this other provision that states that distribution of revenues from a trust to a Colombian person, they are subject to a capital gains 10%. So I don't know how to harmonize and in case it were applicable, how you would apply the rules, the CFC rules of the revenues of the underlying companies in the trust versus this other provision that states that the distributions made by the trust will only be subject to a 10% capital gains, which is a provision that has not been changed under the tax bill.
Is the 10% participation, is it determined by vote? Is it value? Can you attribute to other parties?
It only talks about 10% participation, like the only provision that, or the only provision that expands or developing that concept is that if you have option to purchase participation, that option to purchase certain participation will also be considered in order to determine that 10% or not. But that's the only regulation that we have at hand right now.
And I see insurance arrangements are left off as far as being subject to these rules.
Yeah, exactly. In insurance policies and insurance contracts were not touched by this tax bill, so we're still subject to the general provision stating that the net worth value of insurance policy will be the surrender value of the policy. And it's interesting to know that authorities are not aware and do not have not investigated or have not studied that issue. When we started to look into these insurance figures, we requested some opinions to tax authorities regarding how that particular provision works and who is the one obliged to report the net worth, the surrender value of this insurance policy, and they came up with two very interesting questions, which I think that can give space to a lot of planning. For example, the first thing that they said is that the person obliged to report the insurance policy is the beneficiary of the policy, and they said that in two different opinions of last year's, which are still in force. And the second thing that they also concluded was that insurance policy subject to reporting were only insurance policy that have a savings component. So I think that gives a lot of space to other type of insurance products that, according to those two provisions in the form in which the law was interpreted, maybe are not subject to report. And also the fact that in the conclusion that the beneficiary is the one obliged to report the policy, can lead to certain situations whereby, for example, the beneficiary does not know he's a beneficiary, so that no one would report the policy. Or the other situation is if it's a policy that does not have a saving component, those policies would also be, you could have arguments to say that they are not subject to report.
So we're going to go back to some of the structures we had at the beginning. This clicker works. So this is sort of the classic inbound trust planning structure that we would normally use for many non-U.S. people, including Colombians, because it provides an estate tax blocker for non-U.S. people who want to invest in U.S. stock or other U.S. situs assets. Under the new rules, well, let's just start with where it was before the changes. What I understood before these changes is that the trust, if it has a non-Colombian corporation under the trust, there wouldn't be any tax consequences to any Colombian people until a distribution was actually paid out. Is that correct?
That's correct.
So now, under the CFC rules, what's the impact?
If you say that the Colombian settler has control over the whole structure, and and he indirectly has more than 10% stake at the underlying companies, then the CFC rules would apply, and he would be subject to report that taxable income in Colombia. But again, I don't know how that works with the other 10% rule, because typically that would be subject to a 10%, and now they're changing the rules completely, and the provision that talks about the 10% was not touched here. So I don't know if you can say that you will make the distributions go for the 10% and disregard the CFC rules. Right. I don't know if that's a possibility. I think we have to wait how they're going to regulate that particular issue, that I think that nobody thought about that when they established the CFC rules.
And would one of the ways to sort of minimize the impact of the CFC rules for these type of structures now would be making the trust irrevocable and not giving any Colombian person, whether it be settlor or beneficiary, control?
Absolutely, because then it will be clear that it is not controlled directly or indirectly by a Colombian party, which is one of the two requirements in order to apply the rules. So I think that would be very useful in order to say that they are not applicable.
So from our perspective, if we had to switch gears and go from revocable trust to irrevocable trust, but yet we still wanted to have what we call a grantor trust, which is transparent for our purposes, then we're limited by how we can achieve a grantor trust now. It's either going to be revocable, which would cause the CFC rules to be affected, or it has to be irrevocable, but the only beneficiaries are the settlor or the settlor spouse. So it could, impact our structuring for Colombian persons for succession planning. Let's see here. We'll come back to that in a second.
I just have a quick question on the CFC rules. Going back to Jennifer's first diagram.
Oh.
Sorry. On the left side, there's, the foreign corp, and on the right side, you see the foreign corp owning a U.S. corp. What if it's a Delaware U.S. LLC, not subject to any tax, it's a flow-through entity? Would Colombia see that as a CFC? A lot of foreign countries treat Delaware LLCs as tax havens, and would they treat that as a CFC?
Yeah, they do not make they do not make any difference currently. So if it's control, if you have qualify under the control and participation test, it will apply the CFC rules.
But again, only passive income, right?
Of course.
Yeah. Okay.
Yeah, but just to a pair of comments regarding the application of C rules. There's an extensive definition of the passive income that will be applied in order to determine the revenues. Talking about in particular, it calls the attention about the typical one of dividends interest. It says that rendering of services and trade activities are also considered passive income. So that, for example, in the case that Jeff was mentioning about the commission payments to the trading company, those will also fall under the CFC rule. And there is also an express provision to compensate the tax losses generated by the companies that CFC Rules applies. Those losses are not applicable.
Is there a separate disclosure form that they're going to produce for the CFC rules?
So far, it has not been issued. What they say is that the government will issue more than 50 decrees in order to regulate all the different provisions, none of them which have been issued yet. But definitely that's something that will be subject to regulation.
I just have one quick question before we...
On the prohibition to compensate tax losses, does it mean that none of the rules I have in the CFC I can apply on my income? Because I have a company with an account, a bank account in the U.S., I have losses because I saw I paid interest or I lost money in security, I can compensate it.
No.
So I need to pay everything on only the gains and not the losses?
That's right.
They took that from the IRS.
Yeah, and I think the BEPS action regarding CFC also specifically makes that recommendation. So I think that's not only exclusive from Colombia.
I think your question was, you cannot use losses of the CFC to offset income. It's only the income you get.
That's right, yeah. They cannot be used, and I said again, I think that's not exclusive, and that's following OECD guidelines in that respect.
I just have one more quick question. The U.S. CFC rules, and I know we're talking about Colombia's, but the U.S. CFC rules that obviously tax passive income, but they also tax related party purchase and sales of goods among related entities, where you may purchase or manufacture goods in a high-tax country but sell through a related low-tax country. There's no similar concept?
Not yet, no. Maybe they'll give an idea, but not yet.
Okay. Thanks.
There's also another chapter regarding the exchange of information and how the tax authority, that they grant the tax officers authority to request the banks and financial institutions and other entities required to report all the different information so that Colombia can comply with its obligation under CRS.
And do you think they're going to be able to exchange this year?
I think I understand the institutions have been providing that information to the U.S. I don't know how the CRS will work, but currently financial institutions in Colombia are providing that information to the U.S.
Well, you mean for FACA purposes?
Yes.
But I'm saying for CRS purposes, do you think Colombia will be in a position to start exchanging with other countries besides the U.S. This year?
That's hard to tell, but I think if they already have like the systems and mechanisms in place to report to the U.S., I don't see why they cannot like expand and do the same for the nationals of other jurisdictions. So I think they would be in that position.
And as noted in the slides, obviously the U.S. is still not a party to CRS, which some people may see that still as an opportunity to have U.S. bank accounts or U.S. structures. And obviously, if Colombians are considering that, then they're going to have to make sure they take U.S. tax advice to make sure they can minimize the U.S. tax consequences.
With regards to the CRS, which requires some bilateral agreements with other jurisdictions, do you have any idea? And also, Colombia's got this non-cooperative jurisdiction list that they're putting together. Do you have any idea how the relations are going with your good friend Panama and also maybe Bahamas?
John here is asking about the situation of Bahamas and Panama under CRS. My understanding is that since Panama also committed to CRS, then that was sufficient for the Colombian authorities that they will get that information, and when the time comes, they will subscribe the bilateral treaty in order to get it enforced. So for the time being, regardless of some other different issues going on with Panama, it will not be included in any list. In the case of Bahamas, my understanding is that even though Colombia is not in the list to execute the bilateral agreements from Bahamas in order to provide or not that information, I have not heard anything or that it will not be that it will be qualified as a non-cooperative jurisdiction. The other issue to mention though regarding FATCA is that so far Colombia has not received any information from the IRS. What authorities have stated is that the U.S. is not comfortable with the handling or any protocols in order to handle that information, and that they are working on it in order to get some comfort. But I don't know if that's the truth or just the story of tax authorities in order to get people afraid. We also had a huge change in the general anti-avoidance rule. We had before this we had a rule that was very difficult in practice to apply, since it required a committee in order to determine whether or not there was abuse. That committee actually was never formed, so in principle that started in 2012, and not a single investigation or audit applying these general anti-avoidance rules were actually put in place. So they changed it, and they eliminated that committee, and they granted the authority to the tax officers to determine whether or not a certain situation falls under the abuse category, and they have the authority to recharacterize certain transactions made by the taxpayers if any of the situations determining the law are applicable or not. Basically, if the transaction is unreasonable from a commercial perspective, if it does not have any substance, and if the real intention of the parties was to have a tax benefit. So if any of those three situations apply, the tax authorities can recharacterize a specific transaction and determine the taxes that would apply if that transaction did not actually take place. But in any case, here the burden of proof in order to determine whether or not a particular transaction was abusive or not stays in tax authorities rather than on the taxpayers.
It sounds a lot like our economic substance doctrine we have, and it's now codified under Section 7701. Okay, any questions from anybody?
In the original project, there was like a disclosure of abusive structures or planning.
That's right. Yeah, he's asking about aggressive planning, the obligation to report. In the original project, there was a specific chapter of that, very aggressive, where taxpayers and also advisors were obliged to report aggressive planning, but at the end of the day, it did not pass through before Congress.
Sounds like our tax shelter disclosure rules.
Other question?
Jeff, I'm not quite sure what the answer was to your question about the CFC rules applying to the Delaware LLC tax group.
Yeah, I'm not sure either.
Yeah.
Delaware will be treated as a tax haven.
Yeah. Regardless if it's considered a tax haven or not, if the control and participation tests are met, then they will be applicable for a Delaware corporation. So
even if it's not considered a non-cooperative jurisdiction, if it earns passive income and you control it, it'll be... That's right. So even if you're subject to a corporate tax of 35%, it could... Do you get a foreign tax credit for the U.S.? Yes, you'll get a foreign tax credit, but they will still apply. Do individuals get a foreign tax credit for corporate level tax?
Yes.
Okay, better than the U.S. rules. All right.
Does that answer your question?
Yes, thank you.
Anybody else? Okay, well, we appreciate everybody coming out. It's a fantastic turnout. Have a good day, everybody.
Okay, thank you.